Welcome to CLS's monthly market review. I am Rusty Vandeman, the Chief Investment Officer at CLS Investments. And with me today, I have Paula Week, Portfolio Manager at CLS Investments. Welcome, Paula.
Thank you.
And Happy New Year.
Happy New Year.
What a great year, what a great month, quarter, everything fantastic.
Absolutely.
And so I think I've said it on every podcast, every video, every commentary, but how exceptionally great this year was with strong returns, low volatility. The market was never more than 3% off its high. It never had a negative month. I mean, it's just crazy good year. But one of the reasons why I have you on here is that what even did better than the U.S. markets is one of your areas of specialties, the international markets. What a great year. Tell us about it.
International markets finally have taken off, and it's just been fantastic to see because it's been such a significant part of our portfolios for a number of years now. But everything just kind of took hold, and so you had emerging markets that were up 37%. You had developed markets up 25%.
U.S. market was up 21% for reference. I forgot to say that. Yeah, go ahead.
Yeah. And 21% for the U.S. market. Who would have expected that as well, especially with all-time highs coming up? But
I was saying expect below average returns myself. So in the U.S., right?
So, but no, and so international markets did fantastic last year. So
a couple of other asset classes we should talk about. First of all, the bond market last year. Even though short-term interest rates went up a little bit, long-term rates were basically flat. Bond market had a positive return, about 4% for the aggregate index. So that was a way better year than I think a lot of people would have expected.
Absolutely.
Another asset class, which is an area which you're just writing a white paper with Brent Engelbart on, is commodities. How did commodities do last year?
Yeah, commodities actually returned 2% last year, but they came back, in the last month. So in December they were up, 3%. So, so it actually commodities we're very optimistic about. They look very beaten down from a valuation standpoint. They look very attractive, great entry point, and then hopefully we see some momentum based off of last month.
So you're already going into our outlook. That's exactly where I was going next. Perfect. You read my mind like you always do. Okay, so speaking of outlook, what about international? 37% return in emerging markets. Do we still like them?
Oh, absolutely. I mean, they're still trading at a discount relative to the rest of the world. And so, but I do think that we probably need to temper our expectations a bit for the international markets, just given the recent outperformance. Valuations still look very attractive, but they look even better in certain pockets of developed markets. So you have certain areas like the Pacific ex-Japan, which are still trading at pretty steep discounts, despite the fact that they were up 25% last year. And then you have areas of the market like Canada, that is also trading at a fairly significant discount as well.
Talking about, what you're talking about is one great resource is, of course, that goes with our monthly videos and monthly commentary. And all of our commentary at CLS has a little box of returns that shows, how the markets did over various time frames. But when you stretch it out over the longer time frames, international has still lagged the U.S. market by so much.
Absolutely.
Over the 3 and 5 year time frames. And you look at a 10-year number, it's just amazing how much emerging markets have lagged despite superior growth statistics, debt levels, demographics, blah, 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 all the stuff you write about all the time.
Right.
Okay, so coming into this year, the outlook, what I said last year, which wasn't right, but I'm still basically counseling it, is investors should expect below average returns in the U.S., not negative returns. I mean, the chances of a loss are higher than usual, but the chances of gains are still strongly positive. I mean, that's just the way history works, the way valuations work, the way the markets work. Expect below average returns in the U.S., above average for international. The bond market is still uninspiring with low return prospects, but still positive return prospects. They still diversify portfolios. As you already mentioned, commodities are an area of great interest to us. Commodities are sort of that wild bucking bronco. It's really hard to ride sort of the commodity asset class because it's so different. But as your white paper is going to outline, from an academic standpoint, it's just really a no-brainer to include some level of commodity exposure.
Yeah, absolutely. Commodities and just real assets in general, as the white paper is going to talk about, you have that huge diversification benefit because of the low correlation with stocks and bonds.
Yeah.
And to me, that looks pretty attractive when you have a bond market and a stock market that look fairly stretched. And then you also have, the income stability with some of the longer term, lease obligations and mortgage. It's absolutely fantastic as far as, inflation hedge. There's so many aspects of it that, and they don't act the same way. So if you have a diversified bucket of real assets, then that's going to just add on another layer of diversification as well. So,
The nice thing about the CLS white papers, while they're still chunky and got a lot of good data, there's also a lot of nice bullet points and easy to extract things out of
Yes.
it. So
Yeah.
I do love our white papers.
Yeah, I do too.
Well, something else I do love, and we just got finished doing it, and I'm just kind of putting a little advertisement into it, is our podcast, The Weighing Machine. So we spent a lot of time talking about you and what you do here. So definitely invite the viewers to check that out too. Hopefully it was a lot of fun.
Yeah, it was. It was a lot of fun.
As was this video.
It absolutely.
All right. Well, let's hope that 2018 is going to be another great year. A lot of things are leaning up to it. It's going to be hard to batter the performance of 2017, but it looks like it should be a good year.
Yeah, it does. Now, I know that you wrote about the tax reform.
Oh, yeah. I couldn't get away from talking about that, could I?
So, yeah, I'm sure that everybody wants to hear about that.
Well, that's a great point. I'm glad you brought that up. So when it comes to tax reform, if there's a bullet point, speaking of bullet points, is that for investors is don't get too excited. It is unquestionably a positive, just in sheer economic terms, because you're putting money in people's hands and then they can decide best how to spend it. Obviously, that's going to have some impact on the economy, and it's going to have a multiplier effect as that money flows through the economy, all positive. It may not be as much as people think. Maybe it's a quarter of a GDP point. Maybe it's 3/4 is the most optimistic I've seen. It's probably more of the former than the latter. But there are a couple concerns about it. Well, before I get to the concerns, one more positive about it, which I do think, is so corporations are obviously getting a windfall too. So what are they going to do with it? Is it going to flow into wage growth? I bet it does a little bit. Maybe not as much as people think, but there's a really strong argument that you could see that. And you are seeing a lot of bonuses for employees right now. The second thing could be capital expenditures. So companies reinvesting in their business for future growth. That would be awesome. And again, I think there'll be some of that too. Probably not as much as I hope. The third thing is that they can return it to shareholders, either through dividends or buying back stock, which has been a big driver of stock market returns in recent years. I actually think that is going to be, again, where most of that money is going to go into. That is a stock market positive.
For sure.
For the economy and the markets, I think those are positive.
And then what about some more longer-term concerns with the policy?
Yep. So those were kind of all the positives, but here's why not so fast. In the negatives, I guess there's three things. So remember, there's three things. I remember my own list here. But first of all, obviously, it's going to add to the debt. And as we've talked about a lot of debt, that's already been a concern of ours. Why is debt a concern? Because you get below average long-term economic growth, which we've seen already in the last 10 years. You get below average interest rates, which we've seen over the last 10 years. And there's pressure on the currency, and the dollar has been under pressure too. So you would expect to see all that again. That would suggest below average returns for the markets as well. But here's a couple of things that could be a concern as well. One is that a lot of the higher real estate markets, such as like New York, New Jersey, California, those higher tax states, this isn't a super friendly bill for real estate owners there. So what if real estate comes under pressure under those states? How will that kind of flow over to the stock market? Because
the populations are so dense in those particular
and there's
states.
such heavy investors in the stock market too. And the third thing is, and I actually think this is something really to monitor, is that, okay, so this fiscal policy, which is positive for the economy, which is called pro-cyclical, it could add inflationary pressures. I mean, inflation hasn't taken off, and or all these arguments why inflation should have taken off already, but it hasn't, whether it's Amazon, globalization, or whatever it is. But it looks like we're getting inflation kind of getting some hold. And so if you have fiscal policy adding to the economy, what if inflation takes off? So here's the thing. So let's say economic growth increases by 0.5%. But let's say inflation goes up 1%.
All that growth is being eaten up by the inflation.
It's illusionary. It's not really growth.
Right.
And so
we already have such a strong economy as well, and it's just,
And how does that weigh in on the psyche of investors, consumers, everything? Never mind if we really get that inflationary uptick, what is that going to do to interest rates? Will that really finally move them higher? And if that moves them higher, all else being equal, that's not good for the stock market. So there are things to watch for. It's nice. The tax reform, it's the biggest in decades. It's probably not the slam dunk, overwhelming positive that maybe some say it is, but it's something that we just need to watch and react to over time as investment managers.
Definitely.
So glad you brought that up. Thanks.
No problem.
Right. That's why you're on here, to help me out like this.
Anytime.
I forget what I wrote about. Well, thanks, Paula. And again, Happy New Year.
Happy New Year.
And thank you for your time and trust in CLS Investments.